as title suggests, I will be going beyond the limited scope of open banking, which is PSD2, and I will kind of try to open door to the new ecosystem, which is open finance, which means much more than beyond the PSD2 version of the open banking, because we will see a lot of use cases of cross-sharing data, not only within the financial industry, but beyond the financial industry as well. Let's get started. So I'll take a kind of top-down approach. We will examine from the strategy lenses what is going into the industry within the format and of who, what, and how. I will show who are the participants of the new ecosystem, what are they doing, and most importantly, how they are doing. And then we will switch to the tech enablers, and specifically tech enablers for the secure data sharing for this information, because into the next phase of the ecosystem, we will be sharing information between finance and insurance, between finance and tourism, between finance and even with agricultural. And we will see during the presentation that the existing security measures and existing tools of privately sharing information, such as, for example, two-factor authentication or strong customer standards of PSD2, are not a good fit for this kind of integration with the partners. And in the end of the presentation, we will end with practical use cases. And specifically, we will discuss digital onboarding, transaction monitoring, and also last use case will be about design thinking within the security, design thinking within the CI Triad, which is confidentiality, integrity, and availability. And on the examples of the use cases, I'll try to show how actually internal risk management and compliance processes could be winners, like business processes are from the openness and from the additional data which are coming from partners within the industry or beyond the industry, from other industry, from cross-sharing of the information. So let's begin with the big question. What is different about risk management in FinTech? Two things come into mind when you ask this question. One is openness and partnership, and another big change is about data. And the openness and partnership inherently means new exposure to risk, because traditionally in traditional banking institutions, we used to have closed perimeter defense model. Within this closed perimeter defense model, we used to have such notion as demilitarized zone, and within this zone we have trusted devices, trusted users, and trusted network. And now we are expanding to the internet. We are doing, as mentioned by previous speaker, we are moving to the internet finance space or internetization of the finance, and we need to think about the tools, how to expand this closed defense model to the internet. Regarding data, as mentioned, when we will be discussing the use cases, we will show how actually from data we can catch up opportunities for compliance and risk management, such as, for example, in KYC, we will have much more data to analyze customers' comprehensive behavioral view, and based on the comprehensive behavioral view of the customer, we will be able to make much smoother decisions about digital onboarding of the client on transaction monitoring. We will kind of dramatically decrease the cases of false positives and false negatives by being able to see comprehensive view of the client from the additional data. Let's have a quick look how openness plus data looks like together. Here on this slide from IBM, we have a customer value curve, and on the customer value curve, we have two kinds of use cases: financial and non-financial adding value use cases, starting from the basic ones such as account aggregation and budgeting. These are very basic use cases coming from the PSD tool. When you aggregate all your balance information at one place based on your consent from different banks, and then a lot of new business models are building based on this enabler, such as budgeting advisory services, how to spend money wisely, where to use specific card to save the money, or using behavioral interventions as a social pressure to kind of spend less money on bad things like cigarettes and move to the gym. A lot of fintechs are emerging based on these enablers. But in the middle, we also see KYC, as we mentioned. There are a lot of opportunities to have a much more comprehensive view about the customer behavior, and we will make better decisions regarding the compliance, regarding the transaction monitoring. In the C section, you can note WeChat and WhatsApp. WeChat and WhatsApp are super apps, as already mentioned, from China, and they already have use cases. Then they have embedded banking services or embedded financial services. Then these super apps embedded partner apps within themselves and have such kind of micro apps within them, such level of integration. And then in the bottom of the list, we have cross-industry sharing of the data between finance and agricultural, between finance and insurance, etc. So this is the illustration how openness plus data looks like and what kind of added value use cases we can have from open finance. So let's think a little bit within the format of the analogies. Actually, we are already using services of ecosystem from tech industry. Think about a restaurant reservation application that has Google Maps embedded into it. APIs allow external applications to read data from Google and portray the data on their own applications. So we all use this kind of feature that we can kind of make a reservation of the table based on Google Map embedded with in open table application, for example. And this kind of example well illustrates how much benefit could be brought to the finance, to the financial services for the customer from integration with partners within the finance industry or beyond the finance industry. But here is the challenge, and challenge is that finance is a highly regulated industry, and in order to have smooth transition to this kind of integration, we need to have answer two big questions: how to secure data, but also how to share data, not only securely, but smartly. Because we will see during presentation of next slides that the traditional measures of the security, such as one-time password or strong customer authentication, are not merely enough for data sharing beyond the finance. And we need to think actually not only about security measures, but smart measures of data sharing and interaction with our partner when it comes to PII, or personally identifiable information, which is the most sensitive part of the information in banking, right? So again, we need to find out new parameter or new parameters, then we are expanding a closed parameter into the internet, and smart ways to ensure a secure data sharing. So I know that this slide looks completely unreadable, but I just wanted to show the kind of helicopter view. What are the main elements in my view of the risks and opportunities associated with the transition to open finance ecosystem? And what I did here is kind of inventory the participants. What are they doing and how they are doing in this ecosystem, and I will kind of dig into the details of the main elements on future slides. On the right corner of the slide, we see enabling security technologies, and the one of the main enabled security technology for the new perimeter or new architecture in the internet to secure our information in the cloud on different sorts of the cloud, like public, private, or hybrid, which are financial institutions moving very rapidly. This strategy is emerging. It's called zero trust architecture. Then we have integrated compliance. We have on the example of EU's practice, GDPR, PSD2, and all the APIs are interacting with the so-called compliance at speed environment. So we need to ensure all kinds of consent management and interactions with the client. And we need to highly automate compliance and risk management processes in order to stay compliant within this highly regulated environment. Okay, this was the simplified version, how all started with PSD2. Who we have here? Banks, fintechs, other companies involved in personal finance or in lifestyle finance business. What are they doing? Data API and payment APIs are servicing as account information service providers or payment information service providers. How they are doing this? They are doing this through B2B business models mainly, and interacting through APIs in a specialized, highly specialized ecosystem market. So all these fintech companies, which come as an intermediary between the incumbent financial institution and all kinds of fintechs which are capitalizing on open banking, are doing this on third parties infrastructures, outsourcing the storage on Amazon Cloud, Microsoft's Cloud, and other public services. And this brings new risks to make sure that information is secure. So that was the beginning with the PSD2, but actually now we are in the brink of the new ecosystem, as mentioned. We are in the beginning of capitalization of open finance. And many major countries like EU or UK already declared that they are considering open banking and the open finance as a pathway to the data economy. In UK, for example, they call this smart data strategy. In EU, in 2019 was declared the strategy, data strategy, and that is the supranational task for the EU, to allow the EU to take full advantage of data-driven innovation by managing the cross-sectoral use cases of data between sectors such as health, manufacturing, agricultural, mobility, energy, etc. As mentioned by previous speakers, there are different strategies to achieve this destination, to achieve the data economy. Some of them are doing this through regulatory-driven approach. Some of them are doing this market-driven approach. For example, best use case for market-driven approach probably is the US. Regulatory-driven approach, well illustrated by PSD2 and by UK. Also, we have kind of hybrid approaches in different geographies, and was mentioned Singapore's use case and the Hong Kong's use case, and we will dig into the details of use case, how actually the regulator is doing very good job to ensure the kind of not only regulatory framework, how to share information, but technical enabler. They are taking ownership of a technical platform of data sharing between the participants of this new ecosystem. And the main technical enabler for this API is connectivity. So in previous slide, we had a list of all kinds of use cases and how they are, how some business models are differentiating from one another, who is who in open banking as for today. But on the next phase of the ecosystem, as predicted by World Economic Forum's latest report, the roles will be changed a little bit. For example, banks are expected to be the data custodians in the data economy, because traditionally banks are the trusted custodians of the financial assets of the consumer. And in the next phase, with such kind of data sharing, banks are expected to have responsibility of the data custodian. We will see this on the example of specific use case on the later slides. So let's have a very quick look into the history to understand how to approach the regulation in internet, because it is good to understand how actually internet was evolved and what was the difference between the traditional media genesis like radio, telephone, and television, and the internet. Traditionally, media was involved with the involvement of regulator at the level of the designing of the processes. For example, when we're making calls from one country to another or from one continent to another, we are doing so based on international bilateral treaties. Traditionally, 50 years ago or 100 years ago, these systems were designed by involvement, by design of the regulator. And how internet was involved? It involved based on internal dynamics. The internet has a little bit chaotic nature of the development. Also, it's good to understand negative goal of the security. By nature, security is negative goal. And what I mean by that is that security specialists must close all 10 gaps out of 10 possibilities. And in contrast of this, hacker has very positive goal. For hacker, it is success to find out just one gap out of 10. But for the security specialists, it is mandatory to close all 10 gaps out of 10 possibilities. And the internetization of this of the finance makes this by inherent hard and negative goal of security specialists even more harder. So this is the kind of zoomed version of who, what, and how framework. And here I dropped key findings, what needs to be changed based on the changes in the business model and industry changes into ecosystem, what needs to be changed from the perspective of risk management processes. As mentioned, the digital transformation gap to address is traditional closed parametric difference model versus new open third-party info sharing and outsourcing model. Then next key finding is that data brings opportunity, as mentioned, so we can capitalize in risk management processes based on the additional data. Thirdly, we need to be agile when it comes to regulation. As mentioned, internet was developed based on internal dynamics. So we need to have a kind of agile goal-based regulations. And a lot of regulations nowadays are writing not rule-based, but principles-based. Regulator gives principle, what is tolerable and what is not tolerable. And the pathway to achieve this is technology neutral. So freedom to achieve the regulation with different technologies is important. Then we approach regulation of the internet and, in our case, internet finance. We need kind of develop an info differentiation checklist when interacting with other partners. We need to develop filters which allow us not to tolerate when it comes to PII, personally identifiable information, but some information actually can be shared with partners, or as we will see on the next slides of data sharing, smart data sharing technologies, not all information needs to be actually shared, but the insights of the information or the result of the analysis actually needs to be shared to interact in open finance ecosystem. So this is the illustration of zero trust architecture. It uses zero trust principles to plan infrastructure and workflows. Zero trust assumes there is no implicit trust granted to assets or user accounts based solely on their physical or network location, local area network versus the internet. Again, what this means is that we need to expand our secure internal networks to the internet. We need to have same control measures when we are talking about the cloud. All kinds of new devices which are coming to our perimeter when it comes to Internet of Things. One point I want to mention on this architecture is that fintech companies have inherent advantage to implement this kind of principles by the design, because it is very hard to move from incumbents, existing and legacy architecture to this kind of trust architecture. And fintech companies can, by design, begin to implement this kind of architecture. And this is going to be huge advantage for the fintech companies as we emerge to the more mature phases of the ecosystem. So in conclusion, this zero trust architecture is for consumer trust, to ensure the consumer trust in the internet space of the finance. Here is the illustration of all kinds of APIs based on PSD2. Then they are interacting between incumbent and all kinds of fintechs. And we see that a lot of consent management should be done. A lot of pop-ups should be implemented during this interaction of the APIs. A lot of focus nowadays on the availability part of the APIs, which is of course important. But as we emerge to more API-driven economy, more needs to be done for the baseline principles of APIs, like to make the inventory of APIs, such as we have, for example, traditionally PCI DSS standard for card data protection. We need to have this kind of question list for the APIs too, like asset management, which is given here. How many APIs do we have? What do the APIs do? What are the API? Who are the API owners, etc., etc. So this question helps to understand the current picture of the API for organization and to catch up with the risk management processes and as new external APIs and internal APIs are coming into the play. Here is the link to open banking or UK, which I have mentioned during my question. I wanted to show actually the statistics from this, but I'm cautious about time now, and so you can find yourself very good statistics how open banking API are monitored in the UK, what are the performance of APIs, availability, how much outage is there, and how banks and fintech institutions are progressing with the integration into open banking ecosystem in UK. So I have mentioned that there are technical standards which are major part of the PSD2. It's called Strong Customer Authentication Standards. And one of the major control during the data sharing in PSD2 is so-called two-factor authentication. And consulting firm identified 8 major challenges, even within the limited scope of PSD2 to implement these technical standards for the participants, such as too strict two-factor authentication above certain threshold of the payment, as well as to maintain the discipline of the operational system upgrade by smartphone holders. So the point is that for the next phase of the ecosystem, we need to figure out smart technologies for data sharing. And here is the ones published recently in very comprehensive report from World Bank Group, World Economic Forum, differential privacy, one of them. And I will show on the example of nice video from National Institute of Technology and Standardization, how the differential privacy looks like. What is it about?
911 operator, what's your emergency?
My wife is really sick. She's having trouble breathing.
What's your address?
1235, Right Way, Greenbelt.
And what is your wife's name?
Karen Brown.
I'm sending help. Please stay on the line.
Okay.
This is a typical call that 911 operators receive every single day. Each call provides a wealth of information about a person in need. In addition to contact information, EMS and hospital staff add health information to Karen's medical record as they treat her. Most of this data is PII, or personally identifiable information, which is key to a person's identity. This information is stored in large databases all across the country. Use of this data is protected by law in order to preserve your privacy. But what if we could use this data without compromising your privacy? Imagine if we could aggregate data to see trends. What if access to Karen's and others' data show that 911 had received multiple calls about breathing problems around the same time? We might pinpoint the culprit. Right now, use of data in this way is allowed as long as we redact the personally identifiable information. But by removing PII, we drastically limit the data's usefulness, and we don't always protect identities. For example, if Karen lived on a small street, her identity could easily be revealed just by sharing her age and street name. NIST scientists are seeking ways to improve the sharing of data while protecting individual identities through measurement and evaluation. By slightly altering the personal information, for example, Karen's age or home address, we reduce the risk of compromising privacy while still allowing data to be shared. Altering the data is like adding a bit of static noise to a radio broadcast. When your radio is tuned in to the exact frequency of the station, you clearly hear what's being said. But if you move the frequency a bit to the left or right, static noise muddies the sound, but doesn't compromise the message. This process of adding carefully tailored noise and altering identifiable information within whole data sets is called differential privacy. When this process is applied to large amounts of data, it becomes a provable guarantee of privacy. Differential privacy allows all of the information to become useful and actionable data. This can lead to identifying underlying problems or trends in neighborhoods, like reasons for spikes in crimes or a higher number of accidents due to poor road lighting. In Karen's case, access to data revealed that her community was experiencing breathing problems due to over-application of a new lawn pesticide, a problem that was quickly rectified. In today's data-driven world, differential privacy allows us to make more educated decisions that could improve the quality of our lives.
So the main point of differential privacy and other such kind of technologies, right? Federated analysis, for example, is that we can avoid sharing the privacy information or so-called privacy identifiable information, and we can just share the insights and the results of the analysis with our partner. So it was a use case of healthcare, right? We can interact with the healthcare based on this technology. For example, federated analysis is the technology where parties share the insights from the analysis without sharing the data itself. Homographing encryption. Their data is encrypted before it is shared, such that it can still be analyzed but not coded into the original information. Zero knowledge proofs. Their users can prove their knowledge of value without revealing the value itself. So these are the promising enablers for data sharing into the broader ecosystem of open finance and open banking. And as mentioned by Berdia, I think there is important to understand that for the broader ecosystem, we need kind of collective capabilities of technology, not only privacy enhancing technologies, which are very good, are enough to operate in ecosystem and to move finance to the internet. But we need to have cloud, we need to have distributed ledger technology, 5G for much more movement of the data, and Internet of the Things technologies in order to ensure the interaction and collective power of everything, and to move actually to the mature phase of open finance. So while powerful individual, it is the multiplicative impact of these emerging technologies that will be transformative to the financial service industry. 5G, Internet of Things, on one side. On the other side, privacy enhancing technologies coupled with the artificial intelligence and collective cloud computer, they give collectively power to have ecosystem of partners in different beyond financial industry and within broader ecosystem. So here is the use case, what I mentioned in the beginning, that banks are welcome to the new business of trusted data asset stewards, trusted data asset custodians. Let's think about use case. Then new employer is asking, let's think about the use case. Then then person got born in Romania, for example, got job in Germany, and a new employer is asking some onboarding information to onboard the new employee within the EU. The next ecosystem will be such that the original bank in the original country of this new employee in Romania will be acting as a custodian of the data for this client, and based on the APIs, German employer would request automatically onboarding information from the local bank in Romania. In compliance of the GDPR rules, such kind of interactions between industries are expected into the new ecosystem, and banks will be acting inside. In this case, local bank in Romania will be acting as a trusted data advisory of the employer, because traditionally banks are used to be a trusted custodians of financial assets of clients. I wanted to show also one interesting video how actually in Hong Kong, regulator is driving the open banking there, and what is the innovation role in data economy and which taken by Hong Kong's regulator. This is, I think, very interesting use case to watch.
Today, I would like to introduce you to a new market development initiative for the next era, the Commercial Data Interchange, or as we call it, the CDI. CDI aims to establish a consent-based common standard for the data owners to share their digital footprint with banks through their data providers. Today, we rely on multiple one-to-one connections between the banks and the data providers. But under CDI, each bank and data provider will have a single connection to this interoperable platform. And that should make data sharing much more efficient and a lot more scalable. Financial institutions and data providers will be able to easily connect their own systems to this infrastructure. And that will allow the customers to authorize their own service providers, whether it's the utilities companies or the payment gateways, to provide banks with relevant and authenticated data through this platform. And with the customer's consent, the banks can have direct and efficient access to a substantial body of data. And that will enable them to offer the most suitable services to customers, or perform more precise and objective credit assessment. And that, in turn, will help banks address the pain points that I just mentioned. Let me give you an example of what CDI could deliver. Think about a family-run noodle shop which has always got problems getting bank credit. They can now choose to allow its bank to access historical turnover data from its point-of-sale terminals. And with access to this data, and by using AI tools, the banks should be able to make an accurate forecast for the noodle shop sales. And that means the bank can make a credit decision without having to first ask the owner for loan collateral. And hopefully, the noodle shop will be successful and its sales rise above the projections in the bank's model. Then its credit limit can automatically be increased by an appropriate amount in the future. The small importers and exporters might also benefit. Through the CDI, they could authorize the trade servicing platforms to allow their banks to access reliable trading data. And that should help the banks understand these customers' trade counterparties, and in turn, that can reduce money laundering risk. And because of that, those trading companies' access to financing should improve, and their cost of borrowing should fall. With CDI, our aim is to enable bank customers, especially the SMEs, to take more control of their own digital footprint so that they can use their own data to enhance their access to financial services. And of course, we will ensure that the principles of customer consent and data security are upheld at all times. The platform will also be subject to rigorous governance that will include consumer protection measures. This new data strategy is a paradigm shift in the development of Hong Kong's financial infrastructure. We have always facilitated the secure movement of funds through our robust clearing and settlement systems. Now, we will also be facilitating the secure movement of data at the initiation of the data owner to enable more efficient financial intermediation in the banking system. This will be an important catalyst for applying technology to enhancing those timeless principles of banking. Just think for a moment about what CDI can make possible. There could be an array of new financial products which enhances service. There will be reduced fraud and lower compliance costs, which strengthen trust. And there could be bespoke lending with finely tuned pricing, which allows capital to be deployed more efficiently.
So 2 points here as a conclusion. One, that regulators brings a new role on its shoulders. Traditionally, it used to be intermediary for settlements and payments. Now, in the data economy, they are owners for the secure interchange of data on the data platform. So it's quite innovative use case, I would say. Then regulator drives the innovation in open finance. So we finally reached to 3 use cases of digital onboarding, transaction monitoring, and from big data to security by design. Here is the statistic based on the questionnaire of more than 150 European banks within the EU, where these banks are investing their money in which use cases of open banking or open finance. And as we see here, digital identity services and KYC process automation are leading the investments. Why we have this kind of trends? Because digital onboarding and KYC processes on transaction monitoring services are the kind of foundational use cases for everything else. Like budgeting advisory or account aggregation are very good. Very good is integration with the other industries like tourism or insurance and exchanging the information. But if you cannot smoothly onboard your client, you cannot do other services based on this. So these are the kind of processes of which are the foundational layers for the other fintech use cases. So this is not surprising that most of the banks today are investing in these foundational use cases of finance. So here is the first use case of digital onboarding. This use case comes from one of the biggest challenger banks in UK. They are growing exponentially for the last 5-6 years, and I had opportunity to look to the process of their digital onboarding. What we are seeing here is that they have major bottleneck when they onboard their clients. So the process, there are some basic steps in this process. Process begins with the downloading of the app in the client's phone. And we see here that in the beginning, the number of downloads are about 30,000 per day. But actually, conversion rate of the users is 12,000. They are roughly losing around 50% of their potential clients. Natural fail to pass KYC is only 10%, as we see, so 3,000, but somewhere they are losing 15,000. Why they are they are experiencing such kind of problems? Because the group is not backed by the compliance processes adequately, because they have a lot of false positive and false negative issues, and the prediction power of the algorithm is not good enough to onboard all the potential clients in time, or to keep the promise of digital onboarding within 1 day or within two days. And a lot of people, as we see on the next slides, are waiting for the responses from these challenger banks to what's going on with their issue. So open banking has the opportunity to get a lot of additional data from the additional sources, such as, for example, access the third party, such as government organizations, to make through APIs to make much more information available in a real time, or to have access even notarized copies of the information through APIs for the business clients. And as we see here, in bad times, they have false positive 16, and in good times 4. And with the open banking and investing in open banking use case of onboarding, it has potential to accelerate actually digital onboarding of the new clients. Next is digital touch versus human touch. I'm sure many of you have seen the audit conducted by UK's consulting firm called Built on Mars, and they compared, made audit actually of and compared the challenger banks with the incumbents, number of clicks to create an account versus challenger banks versus the incumbent banks. As we see, Revolut, Monzo, Starling are among the undoubtful leaders. And we see in the bottom HSBC, First Direct, and other incumbents, right? Digital touch with the challengers are much more improved compared to the traditional banks. But same consulting firm, after some time, conducted also another assessment. Another assessment was about average time taken to speak with the human on the phone. What we've seen here is that Revolut is in the end of the list. So the point of this slide is that we need to maintain, even in the digital space, even in the fully digital environment, some balance between digital touch and human touch. And I think by compliance officer was rightly mentioned here during the previous session that despite the machine learning element within the onboarding process or transaction monitoring process, you need to adequate staff to respond to calls, because there is no machine learning algorithm or AI that would 100% will predict who is fraudster and who is not fraudster, or whom to onboard and whom to not. And you need to ensure that you have adequate resources in the call center to actually respond in time of the calls. And here is my observation of the problem. part of the decision of the strategic decision of the challenger banks, and in this case of Revolut, we had to invest or under to invest in only digital or semi-digital processes such as call center. A part of the strategic decisions, I think the main issue is to kind of visualize the holistic process. The onboarding process or transaction monitoring process doesn't end with the algorithm or machine learning. It ends with the call center. So you need to visualize whole value chain of the risk data in this case of financial crime risk data. And this will allow you to give single customer view and single behavioral view of your clients to visualize such way. As mentioned, through the cross-industrial or within industrial use cases of additional data from our partners, we can improve single customer behavioral view of our clients. So we have much more adequate view what is the behavioral view of our clients, and we can make right decision about onboarding digitally. Static rules versus interactive models. So traditionally, fraud machines or AML machines in banks are learning are working based on the static rules. So-called, for example, you have geography, you have number of transactions for last 10 minutes, and you need to decide whether it is fraudster or where not. But in a machine learning environment, to bring machine learning environment in this process means that you need to improve your algorithms from the additional data continuously. For example, I used to work for Liberty Bank, which has a lot of pensioners, and actually Liberty Bank is main distribution of the pensions in the country. And the pensions were distributed in the middle of every month from 14 till 16. And the behavior of the pensions was in a way that they would come 80% of the pensions at first days of the pension distributions. If we would apply the same static rules which we had for the regular days to monitor the frauds, for example, one of our main rules were the number of transactions on one particular card for last 10 minutes. And the behavior of the pensioners was that they would make a lot of mistakes on indicating PIN codes in ATMs during the disbursement of the pensions. And if this was not kind of considered by our fraud prevention rules, then we would have kind of big increase of false positive decisions by our fraud prevention model. Another example would be example of Black Friday, and by our speaker was mentioned the number of transactions which is doing Alibaba per second in the peak of the single day, right? This kind of level of transactions are only achieved based on the proper interactive model, so-called machine learning element within the transaction monitoring services. And the transaction monitoring services and interactive models are better than they are integrated with our partners, and they receive additional information within the real time through APIs. So this is the illustration of risk data value chaining. It's not time now for the technical details. Last use case I want to present is from big data to security by design. I was interested to see what high-tech industry players such as Twitter and Facebook has, for example, within their risk management and compliance processes, which can be learned into the banks and imported into the banks, because they are champions in capitalizing on the data, right? And they are champions in capitalizing, including on the risk data. And I made kind of inventory of the main features. For example, when you log from the different device in your Gmail or in your Facebook, if you have a configured feature of the alerts based on the GPS feature, you instantly receive in your Gmail or in your Facebook notification that someone is trying to log into your account. So nothing new in this technology. GPS is around us for a long time, but in finance and by regulator, only only a few months ago was requested for the FAT, for example, to have GPS data into banks. Before, this kind of behavior by banks were monitored based on the IPs of the clients and the devices, and the IPs are not always accurate. So we can borrow such features from the high-tech industry. For example, there is also a feature called graph algorithms, which are used by Twitter, then they are examining connections between different parties. And this feature of graph theory in real time allows you who is connected with whom. And they started the examination of the feature with the cases when they have problem of Russian hackers intervention in the US elections, and they started to monitor who is connected to whom behind this scene. From the fintech industry, or from so-called big fintech, one of the best fraud engines which already employs such kind of features is Alipay's engine of payments. That's why they have in a per second, as was mentioned, on a single day, more than 250,000 transactions. This is allowed because they have such kind of features in their transaction monitoring modules. So I'll be really quick with the rest of the slides. The last point I wanted to make is that how impacts, what is the impact of the COVID-19 on fintech? And one of the major impacts is the visibility of the boundaries between digital risk management and cyber security. Before the COVID-19, a lot of people would mix digital risk management with the cyber security. But with the COVID, a lot of companies made investment, and the COVID actually has accelerated the digital migration. And the workloads on the digital infrastructure has been increased dramatically. So from the risk management, from the operational risk management point of view, organizations must be prepared for this kind of outages. And just the day before yesterday, we had illustration that even Google went out for 45 minutes because of the overload. So the impact of the COVID on the risk management perspective, one of the big impacts is that it made clear boundaries between external threats, cyber, and the assessment of the risks inherent to the new infrastructure, to the migration of the digital. And as we go to the cloud more and more, we need to think about systemic risks, because 70% of the information are provided by only 3 cloud providers. 70% of the all information, including the ones from financial industry, store their data on clouds, are stored on Amazon, Microsoft, and Google clouds. So the example with the outages of Facebook and Gmail shows, I'm finishing, shows us how much systemic risk can be brought by such kind of concentration.
Thank you.